Hi, folks. Dan Bird here with the daily scan for Monday, January 13th. After a horrible day Friday and starting off kind of negative today, it actually bounced back. We'll take a look at that. I'm going to explain what max pain is. This is options expiration week. So, Friday, all the options expire, and usually the market towards the end of the week, usually Thursday, Friday, could start Wednesday this week because we have CPI Wednesday, usually does the opposite of what it had been doing. So we'll see if that happens again. I'll show you what the report looks like, and I'll talk about where it comes from. But before we get started, of course, I'm not a financial advisor. Anything that I say is for educational purposes only, not to suggest anything to invest in, when to buy or sell. You have to understand your own trading style and take responsibility for your trades. So any past performance, of course, does not guarantee future success. So let's take a look real quick first what the market did. On the market bias, really nothing much happened today. It kind of went sideways. So there was a few bearish signals, a few bullish signals, but everything sort of canceled each other out. So it's just going sideways. Right now we have a red light, however, so caution is advised. And we'll take a look at these. Actually, let's go to the market bias matrix to look at the charts. So first we'll look at the S&P. Right here you can see it broke below this channel line, the support line right here, which could also be a neckline for a potential head and shoulders, left shoulder, right shoulder, head. It did break below it, but it closed above it. So you can see it went right down to this line down here, which I've had on the chart for quite a while. This is the bottom of the gap over here. So it actually rebounded right when it hit that support line. So does that mean we're going back to the top up here again? We'll have to find out. Nobody knows, including me. So we'll see. Volume was decent today on this rebound, so maybe it's going to continue higher. Now, we're probably going to get an ugly CPI report on Wednesday morning. So this could be a head fake, but we'll see. The market is still in a secular bull market. So in general, it's going to go higher, but there always can be some downtrends. I'll talk about that a little bit later as well. Let's go back and take a look at the NASDAQ 100. Right there, you can see it's right at the channel line, came right down to the channel line and bounced back up again. So, this line was there before. I didn't just create it today. It's been there for a while. So we could be going right back up again. We'll have to see. And what else? Small caps. Small caps rebounded too, right at the 200-day moving average. And I'd said, I think in a previous show, that it probably was headed for the 200-day. Well, it got there, and now it looks like it's trying to go higher. We'll see. Volume was okay there too. So everything looks like it's bouncing. Is it a dead cat bounce? We'll find out soon, I think. We'll find out on Wednesday, actually. Transportation is also important to watch. Clearly hitting support right at the 200-day. Just can't really close below it. So bounced there again today as well. So that could be starting an uptrend. We'll see. The technology sector actually went down even more. It came back, but it gapped down and then tried to recover during the day. So does not look too good. In fact, one more day, almost regardless of what happens tomorrow, one more day is going to give a medium-term sell signal on the technology sector. The communication sector, which is where the internet stocks are, also not looking too great. All of the sectors kind of look like this right now. Let's go down and look at Bitcoin just for fun. And Bitcoin, interestingly, went earlier in the day, went right below this support line, and then late in the day bounced all the way back up, almost back to the close. So close at 94,168. That's where it is right now. And the open was 94.5. So almost right back to where it opened, but it went all the way down to 89.1, way down here. So Bitcoin doesn't want to go down. Even when it breaks its support level, it bounces right back again. So that's pretty healthy so far. But this is the line we have to watch, 92,000. If it closes below that, then that could be the start of a continuous downtrend. Look at the volume today too. Huge volume on that. Let's just out of curiosity, look at this on a 10-minute chart. Yeah, there's a 10-minute chart. So you can see right here, sold off right up until the middle of the day and then bounced all the way back. This blue dashed line is the open. So came back, almost touched the open right at the end of the day. So right here, basically, this is a 10-minute chart. So basically in the last 30 minutes, last hour, basically, Bitcoin came all the way back again. You can see the VIX down here. VIX actually is just tanking lower. So that's one of the reasons why the market actually did pretty well today. One more thing I want to look at is the 10-year. 10-year went up and closed near its high. So that's interesting. It's at 4.8. It looks like it's heading to 5. 5 is the high for those that watched the video yesterday with Zuber. 5% is the high from probably 10 or 15 years ago. So it's heading there again. If it gets there, I expect it to probably pause and get rejected, come down a little bit. And then we'll have to see if it's going to break through, if it's going, or if it will reverse. But it didn't seem to matter too much. I mean, the market did sell off, but it also came back right at the end. The Dow did great today. In fact, it was the best performing index, where it's been one of the worst performers. You can see right there, it actually did not recover all of its losses from Friday, but it had a really nice gain today. So the Dow looked like one of the better ones today. All right, let's take a look at two other things I want to talk about. One, I'm going to do some slides for this. One is Max Pain. I'll explain what Max Pain is before I actually show you the report. And then the second thing before I get to that report is a subscriber sent me a note saying, take a look at RSP. RSP is the S&P, but it is not weighted. It is the equal weighted S&P. So not the cap weighted S&P. The cap weighted S&P is top heavy with a lot of the Magnificent Seven large cap stocks, whereas the equal weighted levels the playing field, so everything is equal. So it's not affected as much by those large cap names. So I'm going to look at that. It was a very interesting comment, and I put together something to actually show you what it looks like. So let's first go talk about Max Pain and what it is. So this is the best way I think I can explain it. Max Pain, basically, when options expire on Friday, there are a whole bunch of call options, which are the ones here in pink, and a whole bunch of put options, which are the ones here in blue. And wherever the value, the dollar value, where these equal each other, basically where they balance out, that is the Max Pain price. So if the current price is lower, so let's say this is 355, if the current price was down here at 300, let's call it, down in this area, then the implication is that there will be buying to get it to Max Pain because it's lower than the Max Pain price. On the other hand, and that usually happens when there are lots of puts that have been bought. If there are a lot of calls, in the last week or so, there have been a lot of puts. So that could be one reason why this could go up this week. But if there are a lot of calls that were being purchased because everyone is very bullish, thinking the market's going up, which actually was the case before last Friday, then you should expect selling, basically the opposite of what's happened before. And the selling then will bring the price of the premium down. So if the stock is, let's say, at 402, then in order to get to this Max Pain equilibrium point, there would have to be selling in order to get it back to this equilibrium. So that's how Max Pain works. I want to stress, we call it opposite week because the market typically does the opposite of what it had been doing. I want to stress that when I show you the report, which I'll do in a minute or two, it does not mean that the price will go to this level. in this particular example does not mean that the price will go to 355. If the price was at 400, all it is indicating is that the direction is towards 355. It could just go down to 380, but the direction most likely is towards the max pain price. So the max pain price will either be negative, meaning that there will be selling, or it will be a positive number, meaning that there will be buying. But it usually does not get to the max pain price itself. It just indicates direction. All right, so I want to show you the RSP, the S&P equal weighted. Great comment from a subscriber. Thank you very much for sending that in. Appreciate it. So here, and I'm comparing this to 2021. So what he said was, take a look at RSP on a monthly chart. It looks very much like 2021, just before the market went down in 2022. So I put this together. I'm going to show you 2021, and I'm going to show you what it looks like right now. So here's the 2021. These are monthly, remember. So this is October, November, December of 21. And this is January of 21, which is where we are now. And you can see the market had been hitting new highs, continued to go up through this whole period, all the way from right after COVID. Here's the COVID crash right here. So right after COVID, the market just continued to go higher. This is where the ADX line crossed right here. This is November of 2020, where the ADX line crossed. We're going to look at that on the current one as well. So that's what it looked like in 2021. And remember, in 22, right after January, the market just continued to go lower. So let's look at what it looks like today, right now. Here's 2024. Here's the same period, November 24, November 21. You see the market went up in this case in November. It kind of went down a little bit in 21, but December went up. In this case, it actually created an engulfing candle, an engulfing monthly candle, which is a reversing signal. Needs to be confirmed, and so far it is, but this is a monthly, and we're only halfway through the month so far. So we'll see what happens with the rest of the month, but look how similar, and here's where the ADX line crossed right here, November of 23. Back here is November of 20. So just compare these two charts, and the person that sent this to me is absolutely correct. They look very similar. Look at the MACD lines up here, how they're starting to converge, just like they are right now, beginning to converge right here as well. So they look very similar. So in fact, the histogram is just getting ready to go below zero in both cases. When that happened in 22, the market continued to go down. So I'm going to show you what 22 looked like after all of this. There's 22. So this is the same square as up here. And here's February. Basically, this is January right here, completed. And this is January just starting. So here's January right now. This is the same period. That's the same first 2 weeks of January in 21, same first 2 weeks in right now in 25. So they look kind of similar as well. And here's what January finished, that candle there. And for the year, it was a 22% decline. So is that going to happen again? I don't know. Nobody knows. I don't have a clue, but it certainly could. It's certainly lining up that way. You know, as they say, history doesn't repeat, but it often rhymes. So what's going to happen next? What's going to happen this year? We don't know yet. But it's very interesting that those looked so similar. All right, so let me now switch over and show you the Max Pain report. This is, let's see, where is it? Here we go. This is a report that's done by Tom Bowley and Matt Townsend for earningsbeats.com. If anybody would like to get this, and they have a ton of research, a lot of things that they do, a lot of things I've learned from Tom for technical analysis and from others as well, but he's a great technician and his website is fantastic. So if you want to really get a lot of great content, I highly recommend earningsbeats.com. You can go over and check it out. They actually have a trial. So if you want to try it out, I think it's a 30-day trial actually. So if you want to try it out, you can go over and probably get this report as well. I'm not going to go through the whole thing, but I'll just show you the high level. They're also not investment advisors, just like me. So here's the Max Payne report for January of 25, just came out today. As what you can see is the SPY, the S&P, has a Max Payne target of 564. Now, just out of curiosity, today it ended at 5. That's not the SPY. Hang on. I'll tell you what the SPY ended at today. SPY ended at 581. So pretty much what it closed at on Friday. So 564 is the Max Payne target. That one actually could reach that. It's only a 2.7% loss. The Qs, however, Max Payne target for those, let's see. I'll tell you what it is right now. We're closed today at 505, so a little bit lower than Friday. So that's a 4% decline if it goes to 485. Now, the Russell 2000, on the other hand, has more puts. So when there are more puts being bought, that means the Max Payne target is higher, which means there will probably be buying 2.8% up to 222.90 for IWM. And that ended today at 217. So a little bit higher than what it did Friday. So it's already headed that direction. So again, this is a directional implication, but what you can see is the amount of net call or put premium right now. So here's a negative, which means it's net put premium, and that's why it goes up. If it's positive, then it would go down before next Friday. But look at some of the names here. NVIDIA, that's a 36% decline. Now, is it going to drop 36% by Friday? Absolutely not. I don't think there's any way that's going to happen. But it certainly could go down. And Tesla, the same thing, almost 36% on that. So remember, this is not the price that it's going to. This is just a directional cue. And what you notice here is there, for NVIDIA, is $12 trillion of open net premium on NVIDIA. So do you think market makers would be just perfectly happy to let NVIDIA drop and not have to pay out that premium? Now, certainly it's not going to go to 86, but even if they can save themselves 1 or 2 trillion, it's certainly a reason to go ahead and let these names drop. You can see MicroStrategy is in there, 40% would go down if it were to hit the Max Payne point. So these are all the Magnificent Seven primarily in here. You can kind of see the rest of these. Down at the bottom are the ones that would go up because they have more puts. So AMD is the bottom of the list. So it potentially could go to 121. Intel right there to 22 almost. So if you look at the opposite side, you see the ones that potentially directionally could go up. So that's what Max Payne is all about. We'll see. Right now, it's implying a slight decline by Friday. So we'll see if that's going to be the case. A little bit higher for the Russell. So just keep that in mind. Again, it doesn't mean it's going to hit that price. It's just a directional cue. All right. And I highly recommend Tom's Earnings Beats site. If you want that report, you probably could just sign up for a trial and get the report and give you some time to look through it. There's a lot more to it actually in the report. He actually explains how he calculates the Max Payne, similar to that slide that I showed you. All right. The next thing I want to talk about is there was somebody that responded on one of the YouTube channels when we were talking. I think it was Zuber's channel. We were talking about CPI. CPI is coming up on Wednesday. And they said CPI is can't be trusted because if you go by that, then software would be 73% lower right now. But that's not how CPI works. And I explained it on the video, so I'm not quite sure why it didn't take. But On the video, I explained how CPI works, and I'll do that again real quick right here. And the comment that I made, so here's CPI. The comment that I made is CPI is based on a 12-month window. So when we say CPI came in at 2.7%, you can't take that 2.7% and apply it to the last 25 years. It's just not how it works. In fact, that's trying to compare apples and oranges. 25 years ago, there was a CPI, but that CPI 25 years ago was based on that period 12-month window. So it's just a 12-month average. As soon as you get outside this 12 months, you could even go back 18 months and you wouldn't be comparing the right things. So you certainly can't go back 25 years and try to compare the price of things back then and say that they should only be up 2.7. The other thing about CPI is that this 2.7 is a rate of change, an annual rate of change. So this means that it's going up 2.7 per month over a 12-month period. That doesn't mean it's going to be 2.7% higher and stay there. It will continue to go up 2.7 every month. So let me show you the cumulative CPI, and this is really what he was talking about. He's talking about cumulative inflation. If you want to go back 25 years or even 2 years, you have to look at it cumulatively over that time period. So here's the chart for cumulative inflation. Let me see if I can make this a little bit bigger. There you go. So this goes back to 1990. You can see how, and maybe this was 2.5, 2.7% per year, but that gets tagged on every year, every single year. It's 2.7 or 2.5 or whatever it is. And it just continually goes higher and rarely ever goes lower. In fact, when it does go lower, like right here during the financial crisis, you have deflation. But this is cumulative inflation. So now the comment that he made saying that, software 25 years ago would have been a negative 73. Well, if you look at it cumulatively, that is accurate. That's correct. In fact, over 31 years, it's gone up 108%. That's up until 2021 right here. And right in here is where COVID hit. So that right there is the 100-year pandemic. And you have to always keep that in mind. So here's basically the trend of inflation right here. And then you can see how it spiked. So it went up basically almost 21% in just a 4-year period. So over this 31 years, 108%, that averaged 3.5% per year. But just the 4 years here, the last 4 years, inflation has gone up on average of 5.25%. That is significant inflation. And you can see that it's still going up and it will continue to go up. If it doesn't go up, then we have deflation. And we're actually pretty close to that right over here right now. And if you get deflation for too long, then it starts to take hold in the economy and people won't buy anything because they think it'll be cheaper next month. And they'll keep putting off purchases and companies won't be able to manufacture things because there's no demand for it. So they'll have to stop building things, which means they have to start laying people off, which means people lose their jobs. They don't have the money and then they can't afford things. And then they wait because they think it's going down even more, which it probably will, but they don't have the money anymore. And that's how you get a depression. That's what happened in 1929. That's how the depression started. Went into a deflationary period. Right now, we had hyperinflation right here in the last 4 years, and it's just beginning right now to level off. There's peak inflation right down here. So this is the rate of change, the 12-month rate of change. That's what CPI is based on, 12 months, not 25 years, not 2 years, not 18 months, but 12 months. That's what the 2.7% means. This is core down here. You can see peak inflation there, and here's PCE, which the Fed likes to look at, peaked right there, and that all of them have gradually started to come down. Now you can see a little curve up right there, and that's what I'm concerned about with the CPI report on Wednesday. If it comes in at 2.9 like they are expecting, that's going to be a significant increase in inflation, and the Fed, not only will they not cut again, they may start talking about raising. And I don't think it'll be the January meeting, but they may actually start putting some words in there saying that they might have to start looking at raising if this continues. So hopefully that helps you understand cumulative CPI versus the number that gets reported every month and everyone focuses on, the 2.7 or maybe 2.9. That's just a 12-month window. You can't use that number and compare it to 25 years. It just doesn't work that way. All right, so now I want to take a look at a few stocks that people have asked me about. Start off with BDX. Oh, by the way, before I do that, on the portfolios page, I added another group of dividend stocks. And so I put the aristocrats in here, which are stocks that have increased their dividends every year for 25 years. They have to be in the S&P 500. But there's also one called Dividend Champions, which is a little looser in the requirements. So in this case, it's 3 billion or more, and it does not have to be in the S&P. So there could be other stocks, but the criteria that I used was similar. So dividend yield of 2% a year, market cap in this case of 3 billion. For the aristocrats, it was 5 billion. Positive earnings, so they have to be profitable, and outperforming both their industry and the S&P over the last 2 quarters, and the price is within 5% of the 200-day moving average. So that criteria is the same as the aristocrats up here, but it's running it against a different group. So there's certainly overlap. So one way you could do these is look at the overlap between aristocrats, champions, and then the Vanguard high yield. You could look at the overlaps between those and pick and choose, or you could just take the ones and make sure you're diversified by picking different sectors. However you want to do it, these are meant for long-term investing, for dividend, people that like dividend stocks. This is one way to find the best ones, just looking at these lists right here. But I mentioned that because BDX is in that list, the champions list. I noticed that when I was putting it together today. So here's BDX. Let me look at this on a weekly chart first. So right now it is in a long squeeze. That is a very long squeeze right there. In fact, I'm going to try this a little bit different. And let's actually look at the squeeze charts too. So we'll go to the advanced charting program for stock charts. If anyone is a stock charts subscriber, you'd be able to get these kind of charts as well. So let's look at BDX here. BDX. I'm sure it's got to have a squeeze. Look at that squeeze. So this is a daily chart on the top, a weekly chart on the bottom. So it's in a squeeze, just started another squeeze on the weekly, been in a really long weekly and a really long daily. I mean, that is ideal. This thing right here, the breakout isn't until 242 up there, but it looks like it might be just beginning its run. So in fact, down here, we look at, let's look at it over here using the Keltner channels and the ADX. Both of those I did on a Technical Tuesday, so you can go back and take a look at those. But right now you can see it's right in the middle of its channel. So reversion to the mean, it went down. Now it's reversion to the mean. It's continuing to go up. And down here, the 25 line is right up here, the blue line. So it's still below 25 on a weekly. You like to see this green line. It's already crossed. So the entry would have been on this bar right here when the green line crossed above the red. But you'd like to see it above the 25 too. That implies a long-term, very long-term trend. I mean, this could potentially just keep bouncing in this channel right here. So you'd really like to see it get above the 25. But if we look at it on the daily, again, here's the Keltner channels. It's up near in the 2x range right now. And in this case, it is above the 25. So it gave its signal way back here on 12.2 on the daily chart. And on the weekly chart, the signal was 11.4. I'm sorry, over here. Signal was 12.16. So just about the same time frame. And this is a good reason to use both weeklies and dailies. Weekly, certainly you could use for a long-term investor to look for entries, and maybe you would enter when it gets above the 21 right there. But you can actually get an earlier entry by combining the weekly and the daily together. So you can see that the daily actually gave a signal a little bit earlier, 12:12 on that one. The other one was 12:16. So it was up probably both within the same week. They were giving the same signal. All right, that's actually looks pretty good. Let's look at the next one. This came from the same person, LW. LW does not have a squeeze. It's sold off quite a bit. So this is Lamb Weston's and food products, consumer staples. That's a defensive sector. So if the market does start to decline, then that sector might do well. And you can see here it's sitting right on support. So this is where it needs to start making a move. But momentum has not moved higher. And the weekly momentum is starting to move lower. And it went up and hit the 50 and got rejected right there. So again, it is above the 25, but it's red. So it's the red line. Let's look at this again. So now you can see the bearish line, the red one, is now above the green one. So this bar right here, 12.9 that week, was the signal to get out because that's the sell signal right there. And it's above the 20, above 25. So that was the signal to get out, and you can see what happened right after that. Continued down. It has not yet given a long-term signal to get back in. And if we look at it over here on the daily gave its signal right here on 12.19. You could have probably had a warning sign right there, but that was earnings. So you can see right on earnings, they must have missed. So it went down, came down here, sitting on support. It's in the 3x Keltner, so that's usually where it will bounce. And if it does, it's probably going to go back, reversion to the mean, right back to this area here. And then I would suspect it will decline again from there. So if you're looking to get out, I'd probably do it when it gets back up here to around 65 or so. Just my opinion. I'm not making any recommendations. All right, the next ones are from somebody that said they're in these for dividends, and long-term, very long-term investing, but are getting killed. So this is actually did well today. So had a nice day today. This is Schwab Dividend Equity ETF. This is an ETF. I don't know what the holdings are in this ETF. Be interesting to look at the holdings in this one and compare it to the dividend lists that I have on the website. But if we look right here, you can see clear support right there. This is the daily chart. So right here, pretty clear support. It actually came down and started moving up a little bit higher than this. So that's positive. And the momentum is starting to improve, but it had a good day today. So maybe this is the beginning of an uptrend. Hopefully, if we look at it on the weekly chart, you can see here that the momentum is just beginning to decline. So it might still have a little bit more time left, but this one up here is a little bit smaller than the previous one to the left. So that means that the momentum might be turning up. And it had a nice one today, but it still needs to get above the 21 and the 8 moving average right here. So needs to prove itself some more. We'll see what happens with the rest of the week. And you can look at it, same thing over here. We'll do it on the daily. You can see the exit signal right over here on 12.4. When it started going down, it went to the median. It went up to the 3x, came back to the mean. Normally when it does that, it goes to the 3x, and that's a shooting star reversal candle. That's a shooting star reversal candle. When it gets to 3x and comes back to the mean, which is the 21, now it has a hammer, and it went right back up to the 3x. So when it came back to it right here, what you would like to see is for this green one to stay above the red, but that didn't happen this time. So that was a signal that it's probably going down to the 3x to the downside. So probably time to get out. And it did go to the 3x and then came back up. So it looks like it's trying to get back up to the mean, and we'll see what happens once it gets there. Might be recovering. We'll see. Next one is LYB, also a dividend payer. Lyondell, again, looks good for today. Today was a good move. It's in commodity, it's in materials. So this one actually is above the 21. So it looks like it's starting to make its move. It actually has a squeeze today. So that's positive. Everything else looks like the squeeze is going to be to the upside. So this one might actually start to move higher. So that actually looks pretty good. On the weekly, you can see momentum is just starting to improve. So the bar is a little bit shorter than the previous one, and also the color change. The dark one means it's going down, the lighter one means it's going up. So again, it's trying to make a recovery. I'd like to see this turn into a green bar like these, like I talked about in a technical Tuesday previously. So, and this momentum is starting to move up. So this one, again, is like the others, looks like it might be just beginning to move higher. So it's right back to the mean right now. So I went to the 3X, went sideways, and now it's going up. So, and look at the green. The green just moved above the red right there. So that's good news for that one. That one might be in recovery mode. And the last one here is J&J. Also dividend stock. It came up a little bit today too. It is in a squeeze, and it looks like a squeeze to the upside. So you can see right here, 1, 2, 3 days. So, and momentum is starting to move higher with good volume today. So this is in healthcare pharmaceuticals. So again, this is one that looks like it might be recovering. It doesn't, the momentum down here on the weekly has not yet improved. It is a little bit on the MACD up here. So it's just starting, and it changed from a red to a blue, but it did that before. You'd like to see it change to a green. That's the time to get in. When it gets above the 21 and it changes to a green bar, that's your signal to get in. The signal to get out, by the way, was back here. It changed to a red bar even before it went below the 21. And then the next was a confirmation. So you can see up here where the MACD crossed and it went below the 0 line on this blue bar. So that was the first warning signal. And then you get a red bar the next time, and that would be the signal to get out in this case. All right, so that's those. Two others that someone mentioned, and not really for me to look at, but I'm just curious, and they're related to the VIX. So this is SVIX. This is short the VIX, which means when the VIX goes down, short. This is shorting the VIX, so it actually goes up. It goes up when the VIX goes down. I think I got that right, and it looked pretty good, but it's still below yesterday's. So I was watching the VIX today, and it actually started to improve as the day went along. So I don't know. So UVIX is the other one, which is the opposite side. So this is the long one, long VIX. So this is when the VIX goes up. This one should go up with it, but it's going down instead. Interesting. So anyway, that's VIX, SVIX, and UVIX. That's it for today. Thanks for watching. And I hope everyone stays safe and watch the market tomorrow as we head into Wednesday's CPI number. It's going to be interesting to see what it does. It looks like it wants to go up right now, but let's just look at the S&P. So there's the S&P on a daily. Looks very much like the VIX, doesn't it? So it gapped lower, and it only just came back to just about where it ended on Friday. So I'm not convinced that this rally is going to hold, frankly. I think that might be a reaction rally that we got today. You can see over here on the weekly chart, it's right at the 21 week. It's got 2 red bars, and momentum is definitely declining. And the MACD line is already below, but it hasn't gone below 0 down here. But this does not look very healthy right now. Let's see what it looks like over here on the Keltner channel. So it's not to the 3X yet. I would be more comfortable that it's going to rebound. It did get right to the end of the 2X, so that could be enough. But you see the red line, not only is the red line still above the green, but it's moving away. It's actually expanding, moving away from each other. So that implies the momentum is still to the downside for sure. So I don't know about the little rally we had today. Not sure it's going to hold. On a weekly chart, you can see right here, the red is it's just going sideways. So they're moving back and forth. This is usually where a squeeze typically happens when the ADX lines look like this. But right now, it looks like the red might be getting ready to go back. Again, it ended right at or a little above the 21. So it's trying to make that recovery, but I'm not convinced yet. It's going to have to do a little bit more before I think it's doing well. Just out of curiosity, we can go on the charts page and look at the daily. So this is a 10-minute chart with the aggressive sectors and see what it did. So the vertical line is Monday. The blue line here is Monday's open. So that's where we open today. The red line is last Monday's open. So you can see how far down we've gone since 1 week ago. So it was coming up, and actually right at the end of the day, last 10 minutes, it had a little bit of a surge. That often happens right at the end of the day. You can see the volume here at the end of the day. That's rebalancing. It doesn't mean anything. It doesn't mean it's going to continue to go up on tomorrow. It's just market makers rebalancing their books, and they probably had more sells and they had to do some buying in order to balance the market. So that's usually what that means at the very end of the day. So don't put too much stock into that. You see it happen right here, and then what happened the next day just went down. So that's what we look like. Technology is underperforming. Financials so far for the week underperforming. Discretionary is a little up. Services down. Industrials flat. So those are the aggressive sectors. And the defensive sectors, healthcare is flat, staples is slightly down, energy's flat, let's call it. Utilities down a little bit, and materials are flat. So not too impressive on the sectors. There's nothing that telling me here that this is going to continue, although it is starting to move up, and it is ever since noon. So that could continue tomorrow, but then the reality is going to hit the market on Wednesday morning. So we'll see. All right, thanks for watching. Please like and subscribe. Let's try to get the numbers up so I can continue to do this if you find it useful. And let me know if there's anything you want me to talk about, look at, stocks to look at. I'd be happy to do that. Just leave the notes in the comments and let me know anything else that you would like to talk about. So that one person that talked about RSP, I thought that was a very astute observation. So I'm glad we did that one today. Thanks, everyone. Have a great evening, and I will talk to you again tomorrow. Oh, by the way, tomorrow is Technical Tuesday. So Technical Tuesday for tomorrow, we are going to, let me share again. For Technical Tuesday tomorrow, I am going to talk about, let me see, let me get a good one here. Let's look at BDX. So I'm going to talk about the Keltner channels. That's what I use here. So this is one of my favorites buttons. I'm going to talk about, no, I'm sorry, not Keltner channels, but these are the chandelier exits. So chandelier exits, I'm going to talk about how to use them, what they are, what they mean. It is probably not even a secondary indicator for me. It's probably a third indicator, but I do like to see certain configurations, and I'll explain all of that tomorrow on Technical Tuesday. So I'll talk to you tomorrow. Take care.